So good morning and good afternoon, everyone. Thanks for joining our CLSAU webinar. Today's topic is on can the U.S. decouples from, can the U.S. decouple China from its capital markets? Today, we are very happy to have Mark Sharp, the international partner of King & Wood Mallesons. And Mark is specialized in foreign direct investment, M&A, and restructuring in China. He has advised foreign investment projects in all major sectors in China. He's familiar with the China issues faced by the companies from family-owned businesses to Fortune 500 companies. Mark has worked as a lawyer in Shanghai since 1993. He was the first foreign partner to join King & Wood Mallesons China in 2000. And he has been consistently recognized as one of the leading lawyers by the Legal 500. In addition to the legal consultation works, Mark has been appointed as a director to the JVs, WUVs in various sectors, and has also been the liquidations chairman of several large Sino-foreign joint ventures. He's also the author of books, China, the Art of Law, as well as the books of China Strategy, Entry, Operation, as well as Exit. He is currently working on a new book called All I Want is Everything on the Chinese consumers. So Mark is going to give us about 30 minutes presentation and followed by Q&A. Thank you very much, Mark.
Okay, well, thanks very much. Good morning, everybody. So I think there'll be Q&A at the end. So I'll just go through these slides. I just thought this morning, as always, you always think different things when you read your slide deck at the last minute. And I think the question, can the USA force Chinese companies to decouple from US capital? I guess the answer is quite simply, yes, they can. So they can do this by enforcing regulations that require Chinese companies to do things that force a dilemma. So I think the quick answer is yes, but I'll go into a little bit more detail. So I think what we've seen, also perhaps from a law firm perspective, the big headline is that Donald Trump has ordered the regulators to crack down on Chinese companies. Maybe it's a bit due to this Luckin coffee issue. But I think this accounting standards, this has been going on in the background for many years. It was about 4 or 5 years ago, it came up as an issue and then it kind of ebbed and flowed. But I think if you look at it, firstly, the trade war is not really about tariffs. The technology, and what I mean by technology is that the US in particular, but many other countries are putting up barriers to Chinese companies buying companies overseas with technology. I think there's been a lot less of a clampdown on licensing of technology. So that's something which I think people should keep an eye on, but a little bit outside of the scope of today's discussion. And then I think, this last one, which is the latest of this perhaps US-China trade war, is this crackdown on the Chinese companies listed in the US. And this is not really about accounting standards. So I think this is really about something much bigger. And it's really about the fact that the US is trying to suppress China's rise to become a potential competitor. So the dilemma is that the US will start to require Chinese publicly listed companies to let this means Chinese companies which are listed in the US to be reviewed by the US Public Companies Accounting Oversight Board. I mean, that sounds very boring, but what it means is these Chinese-centric companies they'll be in a dilemma because if they do give this foreign access to all the accounting information, this will go up against Chinese national security and state secrecy laws. And as I mentioned a few minutes ago, this came up a number of years ago where the Big Four were really also placed in this dilemma, but the US dropped the issue. So I think that's what's happened. So I'll just perhaps talk a little bit about what is a VIE, because when I was approached about this topic, the real topic was all about VIEs, but the VIE is not really the central part of it. It's an ancillary part. So when we look at what we call a red chip structure, it's that a number of Chinese companies, or Chinese businesses perhaps more accurately, they've been using a red chip VIE model to access overseas capital markets. And so the reason for this was, firstly, Chinese companies who wanted to directly offshore IPO needed special approval from the CSRC. And this was really almost impossible except for the largest SOEs or banks. And so what first started was the idea that a private enterprise would use a red chip structure, which is basically you set up an offshore holdco. This diagram's normally a little bit more complicated. What they normally would have was a Cayman's company and then a BVI company. They had different layers because they were taking advantage of the tax regulations in different areas. And then they would list, typically the Cayman entity. And this Cayman entity was the ultimate owner of a wholly foreign-owned enterprise in China that owned the Chinese business. Now, the VIE came in because, perhaps when we first hear about this kind of setup is because a lot of these companies are tech companies or education companies. And so it was called a SINA model, SINA, because SINA was one of the first big internet companies in China. And so they had to use a VIE model. And a VIE model, if we can see it in the bottom right-hand corner of that diagram, the VIE model is basically a company which is a nominee and it's contractually bound to the wholly foreign-owned entity. So typically in these arrangements, the owners or the founders, the Chinese founders, they would indirectly set up this Cayman company. They would set up this Cayman company, and then that Cayman company would acquire the business in China. And then for somebody like SINA or somebody in a restricted area like telco, internet, infrastructure, media, they would set up a Chinese entity, mostly owned directly by the founders, and this company would hold the operational licenses. So, just in a very simple snapshot, it's just basically the wholly foreign-owned enterprise would do the business that was not controversial, and then it would rely on the Chinese VIE entity to get the operational models to enable it to work. So, and then they would list the Cayman company, and this was disclosed in the prospectuses. Okay. So, foreign companies in China also use VIE models to overcome restrictions on foreign companies as well. So the VIE model is used in both directions to get around these restrictions. Now, what happened was many big and successful companies used it, like Alibaba, Weibo, Baidu, JD, and then these are all internet companies, but also someone like TAL Education Group. So many successful, well-run companies operated on this structure. So they're the high-profile successes. But what happened was there was a lot of scams as well. And in the VIE, VIE, it means the variable interest enterprise, and this is actually an accounting term from the US. So this was not really a Chinese invention. This was an invention by US lawyers and accountants to help facilitate Chinese companies to list in the US. And so, our law firm wasn't really that involved in this because it was really at that stage when it was kicking off, was very much a US dominated business. And what happened was the Chinese entrepreneurs, used the VIE model firstly to get around these restrictions in Chinese law about operating without an operational license. But then at some stage, the entrepreneurs somehow understood, well, what you could do is you could get away with having the whole business in the nominee company, and you just list a basic shell with a contract. And so Sino-Forest Corporation, which was listed in the Toronto Stock Exchange, that was a fraudulent company. And that was perhaps the first one which I can recall, which was one of these issues where this fragility of the VIE was a big issue. And, so, we were, myself, I was a bit interested in it. And I remember I was in New York and I visited one of the advisors, the corporate advisory firms that was doing a lot of these smaller deals. So not the big Alibaba type deals, but these smaller deals. And I looked at the prospectus and, in the disclosures, they would really have every single thing you could imagine, from hurricanes to tidal waves to everything. And then there was this particular company. I just remember, I don't remember the company because I wasn't involved, but just reading the prospectus, it was a pharmacy company. And I had done a pharmacy deal, like a drugstore, pharmacy. I had just done a deal like that a year before. So I was a bit aware of the restriction that you couldn't have more than 30 stores. But anyway, this Chinese locally owned company was only at 15 stores. And in the prospectus, it said, there is a limit that you can't have more than 30 drugstores in China as a foreign-owned enterprise. But we've overcome this because, firstly, there's only 15 stores. But secondly, Mr. Wang doesn't own these stores. The Woofy doesn't own these stores. Mr. Wang's own company owns the stores as a VIE and just has a contractual arrangement. And so this were the kind of things. And when I challenged the corporate advisory firm, like, how does this work? You have such a fragile structure. They just kind of shrugged their shoulders and said, well, it's disclosed. And so I think a lot of these smaller Chinese companies, a lot of it is very fragile. And a lot of these companies did go bust and engaged in very questionable practices. So, looking at that inherent fragility, how could these lawyers and accountants and advisors avoid being sued? I really don't know. This is a question, we investigated when there was the first round after Sino-Forest of these companies going bust. But actually what happened was they would go to those law firms, etc., to explain. These were not small law firms. So I think, the inherent fragility of the VIE has been problematic for many different companies. So, okay, so that's a bit of the history of the VIE and why they use it. But I think it's not as perhaps, central to the whole issue as the red chip structure. And so, there's many, many, many companies who are affected. So I think as of 2020 and, attached to the deck, we've got a more detailed deck that we're happy to send to people, but we've got a list of the companies. It's not quite up to date. I think it was like last year, but supposedly, according to Forbes, there's 170 companies listed in NASDAQ and the New York Stock Exchange at the moment. And they've got $1.2 trillion of total market cap. And so, as you can see here, big guys are on there too, like PetroChina, China Life, China Southern. So I think, it's not just the small cap companies. So this is actually going to be quite disruptive. I don't think it's not going to happen. I mean, it's a strange way to say it. So I think it will happen. This is not going to go away like it did 5 or 6 years ago. I think the US is going to actively push these companies. And I think a lot of these Chinese companies probably feel it's not particularly a good place to be listed anyway, given the current, circumstances. So, the $1.2 trillion question is, well, what's going to happen? I think, firstly, I do think it will happen. And then I think the biggest and most strategic companies, they're probably going to go to the China mainland exchanges. So, if they're not already there. So I think, the big state-owned companies will go. And then the strategic ones, like SMIC is an example, they're going to delist on the new they're going to list on the new Shanghai Star Exchange. And so the Star Exchange has really come up at a very fortuitous time. I think it was established like a year or so ago. And it's, one of the problems for tech companies in China was that the inflexible listing requirements in China, like 3 years profitability and all these things, made it very difficult for these high growth companies to list in China. But I think now with the Star Exchange, they've had a year to work it out, and there's a lot of interest, in listing. And China is not the China from 20 years ago when this was all kicking off. China's now got very deep pockets, lots of funds to invest, and so I think, look, the biggest recipient will be the China mainland, but then followed by Hong Kong. So I think it's going to be Hong Kong. Although I think most of the big ones will go to China. But I think Hong Kong will get some very big ones as well. But I think in particular, most of the tech and education will go to Hong Kong because Hong Kong is close to China, but it still has a very international capital market environment. It's got a large, well-functioning stock market with a solid reputation. And I think, also for those companies that want to be international, they may not want to fully withdraw back to China mainland, but they may want to see Hong Kong as their, foothold, with a foot in China, but also a foot, a bit out. And also, in tech and especially education, a lot of the most successful education companies in China do have strong Hong Kong roots. And, we do have a number of clients who are Hong Kong education companies operating VIE models in China, and they're planning to list. And this was predating, the current issues in the US. Now, I'm currently based in London, very much due to the fact that I'm not allowed back into China because of the virus, not because of anything that I've done personally. But, so being in London, you do hear more about London. So I don't know if London's a dark horse or it's just because I'm here that I hear a lot of people talking about it. But I think that there probably is a role for London to get the smaller public companies who are looking to delist. And it will be especially in those areas where London, the London market has a good understanding. So that would be technology stocks, consumer, and education. So I think these are sectors that London understands, and it would be a very interesting place for these Chinese red chip structures that already have Hong Kong listings or which want to be seen as being more global in outlook. Very much I think Hong Kong's still an Asian or emerging markets play to a degree. So, London could perhaps increase the access to more diverse pool of investors. And I think a lot of people, when they will compare the London Stock Exchange to the US exchange, there'll be less red tape. I think it's going to be much less political. Nobody knows how the politics will play out, but I'm assuming if you see how the UK is, interacting with Huawei, they're trying to approach it in a much more middle road way than compared to the US or Australia or even New Zealand. So, I think the politics might also play a role for China. And we also have that Stock Connect project between the London and Shanghai Stock Exchange. So again, a bit like the Shanghai Stock Exchange and the Star Exchange, there's at least infrastructure, so there's something to build upon. Now, I think a few companies might go private. I only think this because this company called China Distance Education said a few days ago that they will go private. So I wasn't expecting this, to tell you the truth, but that could be something that we will see as well, especially for those smaller listed companies. They may go private. So just a few examples of what's really happening, and I didn't check this morning, but probably something happened already overnight. But so SMIC is really China's best bet at reducing dependence on foreign-made chips. So this is a very, very important company now. And so, it was planning to list more monies. And so it's delisting from the New York Stock Exchange, now, and it's going to prepare to go on the Shanghai's new star market. So I think this will be really, this is probably such a strategic company, and there will be just money flooding at this company. So I think this will be a key example of a company that will go back to China, will get lots of subscription, and will be fast-tracked on the new star market. So a lot of those companies, the famous ones like Alibaba, JD, NetEase, they've all recently filed new IPOs in Hong Kong. And the Shanghai Stock Exchange, they lobbied hard, we understand, to win the Alibaba second offering. But, Hong Kong prevailed. And I think it's probably because of the Hong Kong capital market reputation. But again, these companies are probably companies that are very proud of being Chinese, but also want to be seen as Chinese companies that are very international as well. And so probably that also played into it a bit. So I think a lot of those Chinese companies who really see themselves as international global players, Hong Kong's got a very good chance of picking up those kind of businesses. So look, I'm not a US lawyer, so I won't go into the details of the delisting, but I understand it takes about 5 months. You need a board resolution, and then there's a number of documents to list. So I think what I understand from my colleagues in the London office, because I've discussed with them a little bit about it, it should be a relatively painless operation to delist to London, and there may be ways to fast track it, but equally with Hong Kong. So I think, there'll be obviously due diligence requirements and prospectus and these things, but nothing in here will be difficult for the well-run companies. I guess the issue will be companies like a Luckin Coffee or somebody who really had a poorly put together prospectus or didn't do the requisite due diligence. They may find it more difficult. Okay, so in summary, I think this is really happening. I think China is struggling with a US that's seeking to constrain it. My feeling, and obviously it's just a personal opinion, it does seem that China is not really trying to fight with the US, but the US is aggressively trying to suppress China. So, it's about political influence, it's about technology transfers, it's about trade, it's about markets, and it's about access to capital. And I think, some people seem to feel that this is a very much a Trump issue, but I think this anti-China stance, and I'm not a US citizen or anything like that, but just as an observer, it does seem to be a very bipartisan issue. And so it probably won't go away, I don't think. And so for this reason, I think that this will actually happen. China didn't seem to seek this struggle, but it does need to respond. And so I think these Chinese companies, being cut off from the US capital, this probably was a much bigger deal 20 years ago, I think. But nowadays, if you really look at the kind of tide of history, many of these Chinese companies like Alibaba, Tencent, JD, even Baidu to a degree, a lot of these companies have now been recognized as top global technology companies. So I think many of these companies will find more appreciation and deeper pockets close to home. They'll probably find that more attractive. And some will go back to China mainland. Many will go to Hong Kong because Hong Kong will fulfill that natural capital markets bridge between the East and the West. And, look, our Hong Kong office and a lot of the people I talk to, they're very bullish about this. And, perhaps nobody really, is embracing this US-China struggle. But I think, people in Hong Kong feel that there may be a very large group of deals coming in to their stock market. So, that's, something to perhaps be optimistic about. I think London is probably, I don't really, no one that we've discussed with has really seen Singapore or Germany or any of the European markets as being something that people are really thinking about. So I think London will pick up some listings, but they might be the ones who are already listed in Hong Kong or companies that feel really global, not just Chinese or even Asian in outlook. And I think, the other thing is China's much better positioned to withstand these challenges posed by the US than 20 years ago when the red chip listing craze began. So I think 20 years ago, these Chinese companies were very, very keen to get access to US capital, US market. But the world's changed. China's become stronger and, it's got more ability to do things. And, China's the number one trading company of so many countries in Europe. Germany, who sits at the heart of Europe, its number one trading partner now is China. So I think if you look at, how this all kind of fits together, it will happen because, China can do it and China will find a better way perhaps to do these things. So I think that's now, I'm a little bit faster than I promised. I'm 5 minutes faster, but hopefully there's some questions. So maybe back to Eleanor.
Right, great. Thank you very much, Mark. If you want to, we are going to the Q&A session. If you want to ask a question, you can press the raise hand button, or you can type your question in the Q&A box. We already have the first questions. The first question is saying that, can you say a little bit more about the China's national state and security law that prevented making a deal with the SEC? is this specific to SOEs? What would the large private-owned companies like Alibaba be concerned about in terms of complying with the US accounting requirements?
So I think for state-owned companies, it's really a red line because state secrets are a very there's very little that scares me in life, but state secrets would scare me because so a state secret, obviously, if you remember the case of Rio Tinto, that was a major issue, and it's what information can be considered a state secret is quite loose in China. So everybody knows the Rio Tinto case with state secrets, and that was about dealing with the prices of iron ore, etc. But there were other cases of state secrets too. So even like Coca-Cola, when they put in GPS tracking devices on their trucks, it was about, I don't know, maybe 15 years ago, that was considered to be state secret because that was monitoring geospatial kind of information traveling around. So I think if you look at a company like Alibaba, it is quite likely that information inside their organization would definitely be considered state secrets, because this would involve information about how many people are logging on, how many people are conducting transactions on the internet. And so if you also look at, and I understand the question was about that state secrets in particular, but, it's all about data. So a lot of those companies, the tech companies, they are, all data-driven companies, and data falls within cybersecurity. And so for that reason, I think it's, it could be a hostile environment because they will be put between the US inquiries and a Chinese government that may not want this information provided openly. So I think it is a real dilemma also for private enterprises.
Thank you. Again, if you want to ask a question, you can press the raise hand button or you can type your questions here. So second question is from Elena. The ADRs with the ability will return to home. What options are available for the one who can't or won't be able to return? What are the other variables? And what are the reasons for that? And what will be their ultimate status?
Okay, so ability, that's a good question. I haven't really thought about. I haven't actually thought about that. What happens to the ones who can't comply? I guess these companies will go into abeyance. It will be how tough will the Americans crack down and whether the company does face. So I think Alibaba, as an example, its requirements on the accounting standards is probably due to its size and its importance to the wider Chinese economy. You would think it is a critical part of the infrastructure and would have national security concerns. So I think, just by nature, you would think every major successful company will probably look for an exit as soon as they can. I don't know about that education company who's going private. I don't know if they're successful or not successful, but I did notice that their price was higher than the share price. So I guess, if somebody does have issues to comply, they probably will go private, and that will be then a pricing issue. And then I'm not really a US lawyer, so I don't know what happens if you don't comply with the US requirements. But I guess then the companies who really just are stuck between being stuck in America, then they will have to decide whether they will disclose that information and potentially face repercussions in China. And that will really depend. But I can't imagine it will be many of the major companies. I think any sizable or successful company will be able to find a safe harbor in Hong Kong or London or somewhere like that.
Thank you. Next question is from Maine. Does those issue what is happening in US right now is also affecting companies from listing in other countries outside the US?
So again, I'm not a US lawyer, but what I understand is that the US, I think, one of the issues that China's facing globally is that it sounds like an anti-Chinese regulation, but it's only because it really hits China. So the US is actually just saying, we want the Chinese companies to follow the same rules as the US companies do. And if you have a German company listed in the US, they also follow these rules. So I guess the conundrum for the Chinese side is it's difficult to say it is really anti them, but it's been designed against them. But it's more of a playing level field. And you can see it also with Europe, who I think somebody was saying earlier, perhaps before we started, that Europe's seen as a more friendly jurisdiction to Chinese investment and trade. I think it's true, but also in Europe, you can see there's frustration about things like public procurement. And Europe's not asking for special access. They normally just ask for equal access as China enjoys. So I don't think this is on paper like an anti-Chinese policy, but it just seems to affect China. It's a bit like India brought out a policy a few months ago that neighboring companies who invest in India need to go through a special approval procedure. Nobody thinks Bhutan or Bangladesh is doing a lot of investment in India. So that was obviously, not attacking China, but it was obviously a China-related policy, but hidden as a neighborhood policy. So it didn't look like it was targeting China.
Thanks. Our next question is, what if the US remove Hong Kong's special status, considering most of those companies are coming back to the Hong Kong exchange?
Yeah, I don't know. I mean, I think the Hong Kong special status, I mean, that's like a question about climate change. It would be a lot of potential things could happen. But I think, this is really about these Chinese companies leaving the orbit of the US. So I think it's really more a question of investor status. But I don't think there's that long arm of the Americans, not that I can immediately see. So this is really like you're decoupling yourself from the American capital markets. Obviously, if the US removes Hong Kong's special status, this may have different knock-on effects, which I haven't thought about, investor protections or, access to, US data or things like that. But I wouldn't think there's a direct issue on affecting these companies moving to Hong Kong.
Thank you. The next question is from Maine again. Also, why there are still IPO pending to be listed in the US at the moment?
I can only really answer from our own kind of experience. There were two statistics that I found interesting was, during the COVID peak in China, sale of cars went down 94%. And I'd say even before this whole thing with the delisting, our US office, we got 90% less Chinese M&A deals in the US compared to a year before. And so my question is not really, why is 6% of Chinese consumers in the middle of COVID during the lockdown buying cars? I'm just wondering, who are these 6%? And it's a bit similar with the 10%. I find it puzzling that there are Chinese companies still trying to do M&A deals in the tech space in the US. It's just my own personal view. I find it a very, what's the word for it? Fraught. It's complicated. And, even, some of the deals which we've seen, which you wouldn't think are very sensitive from a technology perspective, have been, pushed back or lots of requirements. So I think, the US hasn't issued the law. They haven't done things. So I guess people are still doing things, and people do things that you think are surprising. So maybe it will blow over. I don't think it will blow over, but I might be wrong. So I think that's the answer. It's, why do 6% of people buy cars when they can't leave their house? Yeah, I don't know. There's always going to be a small group, but I imagine the number of people doing the IPO has been very greatly reduced, and it will be an issue of pipeline, because, you don't do an IPO like, ordering, a birthday cake. You have to plan it a long time in advance. So these were probably things in the pipeline for a long time.
Thank you. Next question from Francis. Many of the company have US investor. While it's easy to be delisted, the ability for the fund manager to buy or convert their holdings to either to Hong Kong or Asia could be limited. How is this factor affect the ultimate decisions?
So, yeah, I mean, I think these are those kind of issues that people were going to have to work through. And it will be also an issue whether places like London have an advantage. Yeah, I think the delisting is simple, but the complexity will be whether the market will, yeah, whether, say, London would have the reservoir to put the money in. So I think that was like a bit similar to that other question about whether if the US revoked Hong Kong's special status, it may have these kind of effects, whether fund managers can do this, whether they can convert it, whether they have analysts in Hong Kong looking at these shares anymore. So it's a bit of a complex issue, which, I mean, to be honest, I haven't totally worked out.
Thank you. Next question is from Aileen. What is the SEC stand? How much influence does SEC have in the matters?
So I'm not a US lawyer, so I'd prefer not to kind of go on to that. So yeah, I mostly just do the China related work. So it's perhaps it would be inappropriate for me to talk about the SEC.
Thanks. Next question from Shannon. What are some limits, if any, to the percentage of ADR's conversions to the ordinary shares?
Well, again, we're going to have to look at the different stock exchanges. You know, it'll be complex. I mean, for London, they have this Stock Connect. So, you know, if it was between Shanghai and London, there's already an infrastructure how to do this. But to tell you the truth, I don't know exactly about how it is between the US and London. But yeah, these are technical questions which I guess will need a little bit more thought.
Thanks. Next question is from Francis. The Star Exchange, is it more lenient in terms of listing requirements? Do
Yes,
the
yes.
company needs more than 3 years of profitability?
This is much more comfortable ground for me than the US stuff. Yeah, so the Star Exchange is much more lenient. It is actually targeted at these growth and technology companies. So it's not just that there's not the requirement for the profitability. Probably the biggest issue will be for some companies is who's got the core technology. So some of these companies that have entities outside of China owning the technology, the question will be whether an irrevocable license to that technology will be enough. But the Star Exchange is much more lenient and it's much more geared to deal with tech companies.
Thanks. Next question is from Sean Mark. Focus of US law rules on the ADR has been on accounting and state secrets. But any sizable company in China require a Communist Party committee, meaning they are controlled by the government to some extent, which the new bill, short of bans, aren't all the other requirement moves should US really tries to suppress?
Yeah, I mean, I think it's difficult. I mean, I think, you know, the opening statement was that, you know, it was, I think the title of this was, can the US decouple Chinese-centric companies from its capital markets? And I think I said the answer was yes. So if the Americans want to do it, yeah, of course they can do it. You know, the Communist Party committee, look, I think any sizable, I mean, I think almost any company of any size has a Communist Party committee. You know, I think it's a difficulty. I can understand that the Americans would think that a privately owned enterprise with a Communist Party committee is somehow controlled by the government. I don't think a Chinese person would share that view. I think it's complicated. It's a difficult issue. Obviously, in China, I would, you know, expect that the government has a bigger role or a bigger influence over industry than, say, in the US. So, you know, we didn't discuss about decoupling, you know, production, but I think, you know, the US can tell American companies, we would prefer that you don't produce so much in China. I don't really know how they do it. It's difficult for them, you know, and I think it's kind of clear that, you know, Chinese private enterprises probably have more respect for the government, but I don't think it really can be equated with saying that the Chinese Communist Party controls all business in China. I guess the issue there is if the Americans wish to say this, and it's about their capital markets, they can do this, and they can say this. I just don't think it's a true statement. I don't think the Communist Party controls all companies in China. But if the Americans say it, I guess they can do that. It's, their capital markets. They can suppress people in this way as well.
Thanks. Again, if you want to ask a question, you can press the raise hand button, or you can type your questions in the Q&A box. Next question is from Francis again. Under the VIE structure, Chinese investors have to a large extent miss out on the upside. How comfortable is the government freeing the market versus the wider control?
So I'm not sure the Chinese investors, I guess we're talking about the founders in that case. And so I think, they really haven't missed out, because the concept of the VIE is that it shouldn't really, of the local investor. Well, let me answer my question. So I'm not really sure about the local investors part of it. But so like, if we're talking about the founders, the issue would be they wanted to list offshore. They couldn't list a Chinese privately owned enterprise. So they set up a wholly foreign owned enterprise, which was owned by an overseas company. But the problem was, let's say it's an internet company, that wholly foreign owned enterprise could not get the right operational license. So they set up a VIE, and that VIE company should really have no real business other than holding the license. It should be very small, and most of the business should be in the wholly foreign owned enterprise. So I think as an economic kind of entity, those companies should be the same. And, so it should have been put together, and it was just a structure to overcome, the impossibility of doing a listing as a Chinese privately owned enterprise. And then I think with local investors, I think it's different. I think they just haven't invested in those companies. So if, a big tech company listed in the US, they may have also listed in China. So I just think the local investors, haven't really missed out. I guess I think it just didn't really happen. And when you speak about government, so how comfortable is the government freeing the markets versus wider control? I'm not sure what that means. I think the issue was, there was an interesting issue about the VIE. So like I said, both Chinese domestic people looking to list overseas used the VIE to overcome the problem that they couldn't list overseas easily without a wholly foreign owned enterprise. And then there are foreign companies, let's say media companies, who also use a VIE to overcome the same restriction, but for a different reason. They want to operate in China, but they can't do it as a wholly foreign owned enterprise. And so I think if we're talking about the Chinese government and about freeing the market, if we're talking about freeing the market, we're actually talking about freeing up that industry. It was interesting. The foreign investment law that came into effect on the 1st of January this year, in the previous draft, there was a provision which people called the VIE killer, which I actually always thought was not going to be the VIE killer, where it was actually stating basically that a VIE, which was used to overcome this foreign investment, this overseas listing, would be okay. So as long as the de facto controller was a Chinese national, it was okay. But they were going to outlaw the VIEs that would help the foreign companies to circumvent the restrictions within the Chinese market. So they pulled that back in the last month or so, and it was deleted from the draft before it came out. And a lot of people think that was due to US pressure on China. So I think, instinctively, the Chinese government knows about the VIE. I think they don't mind it at all if it's a VIE that allowed these companies to go offshore to list, but they weren't too happy about it being to help foreign companies get around restrictions in the law. So it was a very long-winded answer, but I hope that kind of covered the question.
Thanks. You have any questions? You can press a raise hand button, or you can
level playing field. Well,
yeah,
all of us would like to
questions.
see. Yeah, all of us would like to see that. Look, I think the trend of China. China's moved from an investment guidance catalog, which is very, very long, and really was prescriptive about, the investment where it was allowed. And over time, you can see that the restrictions have largely abated. But I think, the issue is in certain sectors, which are unfortunately, very interesting sectors, a lot of restrictions still remain, and we're still far from a level playing field in many of these sectors. So if you look at things like infrastructure, telco, media, software as a service for anything which is very interesting, something which involves mapping, all those kind of things that are either very, very crucial or very hot sectors. They happen to be hot sectors. I think China's still far from a level playing field, and probably to get meaningful access, you need to team up with a Chinese partner. And then I guess the other issue is public procurement. So still in big swathes of the industry, of the market, like pharmaceuticals, railways, things that you do not think are cutting edge or things which are particularly of national, security, there are still many, many issues. And these are sometimes legal, but much more they're in the procurement regulations of state-owned companies. So I think it's better than it was, but you can't say it's a level playing field.
Thank you. If you have any questions, you can type into the Q&A box, or you can press the raise hand button. While we are waiting for the next question, maybe I can sneak in with the question. My question is regarding the new bill, the U.S. bill. Their request to the PCAOB is able to review some of the working paper of the working paper in China. My understanding is that the Chinese government does allow some of these working paper to be allowed to be reviewed. Isn't that be able enough to satisfy the U.S.?
Well, I think it's the question that I forgot who raised it about, whether the Communist Party committee being in a medium-sized privately owned company is enough. I think it's a question. It might be enough. It was enough a few years ago where we had the same problem. I can't remember when it was, about 5 or 6 years ago. It was exactly this issue. It may have been after Sino-Forest, so maybe it was 10 years ago. But the big four were under a lot of pressure about doing audits and releasing the audits of the Chinese companies to the US regulators. And there they came up and the problem went away. I think the difference now is I don't think the US wants this problem to go away. Like I said in the first slide, I don't think it's about accounting standards. I don't think that the trade war was ever about tariffs, to tell you the truth. I think it was about a much more complex rivalry. And that's what makes it complicated.
Thank you. If you have any question, you can type into the Q&A box, or you can press the
Somebody
raise hand
has
button.
a hand. Somebody has a little blue and white hand. I don't know. What do you do?
You can speak out, whoever has raised the hand. Your line is open.
Hi, I just had a question. If the VIEs going outbounds are going to end because of U.S. influence or foreign influence, how about the VIEs coming into China? Do you think that those companies will see any change, maybe a decrease as well?
So I think, look, the issue is it's not easy. It takes a long time for the Chinese government to get laws passed. It's people complain about Western governments, but Chinese laws really take a long time. I think we waited like 20 years for the implementation law regulations of the cooperative joint venture law. So I think it would be difficult for the Chinese government to suddenly issue a new regulation in the foreign investment law, having dropped the ban on VIEs coming into China. The VIE is always in China, but to stop foreign companies using this to circumvent regulations. And also, whatever regulation you would do, because it's a nominee structure, it's difficult for them to, and they're not, in China, there's not that many cases of piercing the corporate veil. So I think in a short answer, I think it won't. I think that China also wants foreign investment. Also for its own economy, and I guess the VIE is used in the most rapidly growing. So I think nobody knows, but I would think it wouldn't be something that would stop people. And the bigger issue is if there was a clampdown, how would companies respond? I think, to tell you the truth, we've got lots of problems. If China started, attacking these VIE model companies, then something's really also changed in China, and there'll be all kinds of issues to deal with. So I think VIE structures are, for the moment, are, relatively safe. And I think whoever used them understood that they are inherently a slightly fragile structure, and they probably realized that there was always an ability in a country like China, where the authorities do wield a lot of discretion, that there was always some commercial risk. But it may be less commercial risk than doing a joint venture with somebody who's a competitor, or doing or just ignoring the Chinese market. So these are complex issues that people have to weigh. So I hope that answered the question.
Right, maybe I have a follow-up question on that. Is that at one consultation paper, they're talking about as long as you registered with the government, your VIE structure will be recognized by the government. Is that still a possibility in China?
I don't know that consultation paper. I never heard of it, but it's like when they had the consultation papers on the NGO law, and the Chinese government encouraged everybody to sign up, and I thought, well, that would really be a way of perhaps self-criticism. I mean, I would think it would be. I don't think there's a mechanism to do it, and the VIE is only a contractual. There's no shareholder registry, so I think I don't know that consultation paper. I don't remember it, but I would think it would be a strange way, because then they're just kind of they're actually noting that the foreign investor is circumventing the regulation. So it's mostly a telecoms license. And so, it will be that you set up with some Chinese nationals, you will set up a company which will go out and hold those operational licenses. And so for me, I mean, they've pared it back over the years. They've made it increasingly difficult. So if you're operating like a streaming business, the company that's doing it actually has to own the trademark. So, and then there's issues on core technology. So I think if there was this consultation paper, I don't think it's really a solution. And if it was me, I probably wouldn't, reach my hand out to discuss it with anybody. I think it would be perhaps counterproductive.
Thank you. We have a question from Jamie. Please speak. Your line's open.
He looks like he's still on mute.
Yeah, you're on mute yourself. Yeah.
Hi, can you hear me?
Yeah.
Okay. So we understand that previously there's a foreign investment law which has not yet given a clarity on the status of the VIE structure. And do you think in the future that China government will try to clarify what the status of VIE and try to what do you think on the direction it would go?
Yeah. So thanks. So I think Jamie. So I think the thing was, there was about a year ago, because the foreign investment law has been out for a long time as a draft, and a previous iteration actually said VIE, if you're going to be Alibaba, it's good, as long as the ultimate controller was a PRC national, and this was done in order to do a listing. I mean, they didn't say that part, but they said as long as the ultimate controller of the VIE are PRC nationals, it's okay. But they said that if you used it in order to allow a foreign company to circumvent the laws, then this was going to be not okay. And they dropped this from the final draft, and that draft was then passed late last year, maybe like December, I think, and it came into effect on the 1st of January 2020. So that's actually very quick when they move from making a material change. And normally when you look at Chinese draft legislation, it's 95% the same as the final law is very similar to the public draft. But in this case, they changed it a lot. So I think for this reason, I don't think they will revisit it in a hurry. And I don't think the optics would look very good, because it will be a lot of, there are more foreign companies than you think using VIE models. But unlike Alibaba or Sina or Baidu, it's not publicly available, because, these companies are not doing this to list. These companies are just doing it to operate. And so I think, it would be perhaps counterproductive for the Chinese government to now cause a big fight with many, many different foreign investors. Where they might do it will be if there is a company. So a lot of those Hong Kong-based education companies operate on a VIE structure. So it may be if there's another scandal with a Hong Kong-listed company, how they operate the kindergartens or something like that, then they may use this and unpick it that way. And that's the only regulation that I know of, is there is an there's a circular by the Ministry of Education that expressly outlaws VIEs. But this still hasn't actually stopped many companies doing IPOs and continuing to work in this space. So I think the practical risk is relatively low.
Right, we only have 3 minutes left. If you have any questions, please press your raise hand button or type your question in the Q&A.
Hi, Mark. I just had one more question about the STAR market. I've read about it a little bit here and there, but can you please expand on that a little bit?
Well, I think the STAR market, I don't think it was invented for this, but I think there was a feeling, that the Chinese stock exchanges are quite conservative. The advantage, I guess, is that there's, conservative, rigid structures. They're not flexible, but at least they're, relatively hardy. And I think there was an understanding that one of the problems was China didn't really have a NASDAQ or something like that. And maybe these stock markets reflected a China of, 30 years ago rather than what China is now with its companies. And probably there was a little bit of anger or frustration that, successful companies like Alibaba, Tencent were listing overseas, and how to capture the 10 cents of the future. And so I think this was really created a few years ago in order to address that. It has much less inflexible requirements, and I think we've got a few clients. It might be a bit of a weird situation. So the Chinese companies, which were very China-centric, were listing overseas 20 years ago to get access to markets, to capital, etc. But we've seen a few, and I can't say it's lots, but we've seen a few high-tech companies in Europe and America who've come to us and said, look, we think with our product, we can do, the business in America and Europe, but China's too big for us to ignore, but we don't really think we can do it by ourselves. But we don't really want to have just one joint venture partner. And, there's two companies at the moment who are trying to actually set up a wholly foreign-owned enterprise in China, bring over the technology, bring in some private equity investors, and then maybe a strategic. And the goal is either to back it into a listed company in China or potentially list on the STAR exchange. So it's a little bit strange. It's a bit like the history repeating in a different way. So, it might be that there be foreign companies who bring technology to China and allow it to develop slightly differently or quite maybe very differently. And it will have its, a common ancestor, but it may be a very different company and it may list on, the Chinese stock exchange. And, you have to remember, a company like Yahoo, I think was an early investor in Alibaba. And then I think Yahoo's biggest asset was its investment in Alibaba. So it could be that for some of these tech companies, their shareholding in a Chinese listed company on the STAR exchange 10 years from now will be more valuable than their business in, Europe. So the STAR exchange, it's potentially a very interesting model for tech companies and potentially maybe even for overseas tech companies.
Thank you, Mark. Sorry, we have one more questions from Francis. Will existing VIEs in the education market with the new MOE circular negatively impacted?
Yeah, not yet, but like I said, I mean, this was a while back. I can drop if you tell me France's email address, we can drop her an article I think we did on it. But we have the details and we have a copy of the circular. But it was a while ago, and I think it's the only place I've ever seen VIE mentioned, except in the FIL draft regulations. So I think it hasn't really affected anybody. We know that there's a number of IPOs still going on with China-centric businesses, so it hasn't had that effect, at least yet, not to my knowledge, it hasn't had any effect.
Great, thank you. I think we are time's up, and this is going to conclude our meeting conversations today. Thank you very much, Mark, and thank you everyone for calling.
Thanks
Thank
for the
you.
opportunity to participate. Thank you.
Thank you.
Bye.